Finding daily bias has always been difficult for majority of traders, but in this video we are going to learn how to find daily bias in 3 simple steps. So let's start off and dig in. Our very first step is drawn liquidity. Drawn liquidity refers to the area where the market is most likely to move due to many stop losses residing there. While dealing with daily bias, we will focus on two types of drawn liquidity: previous day's high or low and daily highs or lows. For the previous day's high or low, the market will either target daily high in bullish market and daily low in bearish market according to our current order flow. It's by far the easiest drawn liquidity you can have as the target. Then we have daily highs or lows. As you know, daily chart is one of the significant and higher time frame, so swing highs and lows there are very significant. They can either act as drawn liquidity, which is dual test, or support and resistance for the rejection. In any case, both of these are very significant. If you look at the depictions here, you can see the set of bullish candles targeting the highs of each consecutive candle. These are the classic scenario in which we target the highs of each candle when the market is very trendy. This is higher time frame, so we'll focus on this candle. You can see we create the low near the 30% range of previous day's candle, or even near the 50% if market is too aggressive to do the manipulation. Remember, we would use other two steps to determine the market direction in more accurate way, but for the drawn liquidity we want to see if we are targeting the highs or we are targeting the lows. If we are targeting the highs and market is consistently making the bullish candles, we would use this formation and try to predict the low near the 30% range of previous candle. And for the bearish candle, we would do the same and try to predict the high of candle near the 20 to 30% range, and then we would target the low. And this case here is for reversal, same for this. In this, we take the low of the bearish candle and then we react aggressively toward the bullish side and target the high. Same goes for this one. This is a lot more clear when we would use AMD pattern and power 3 to see how market reacts after creating this wick. Our next step is going to be order flow. In this step, we'd basically be dealing with bullish and bearish candles and highs and lows to determine the market direction in more algorithmic way. Market order flow can be one of three types. It either would be bullish order flow, bearish order flow, or consolidation order flow. A bullish order flow refers to the market where we reject lows, target the highs, and bearish candles act as true support. So each set of bearish candle will help us go higher toward our drawn liquidity, which would be buy side liquidity. While in a bearish order flow, it refers to the market where we reject the highs, target the lows, and each set of bullish candle will act as true resistance, which will help us to go more aggressively toward the sell side liquidity lower. Then we have consolidation order flow. In consolidation order flow, we keep multiple relative equal highs and lows without clear direction, and market try to pull the liquid through it. So we would be basically skipping the day when market is consolidating. If you look at the chart right here, you can see a lot of examples of bearish, bullish, and consolidation order flow. These gray boxes represent the consolidation where we don't have any specific market direction and low volatility, while this is clear bearish order flow in which we target the lows, reject the highs, and bullish candles act as true resistance for the price. While this is bullish order flow in which we reject the lows, target the highs, and bearish candles act as true support for the price. Our next and final step is ICT AMD PO3. In this final step, we will apply ICT AMD PO3 pattern and clear our daily bias within our lower time frame. We would actually look at the daily candle and determine the market direction with the help of manipulation phase. So if you are not familiar with AMD or PO3 pattern, you need to watch my previous two videos in which I explain each of these in more detailed way. Only two outcomes can come out of this if we are not consolidating, and if we are consolidating, we would skip that market. Either we would manipulate lower or we manipulate higher. These are only two possibilities. In both cases, we look for opposite direction to align with higher time frame order flow after a liquidity sweep. These opposite direction are referred to manipulation. If we are manipulating lower, we want to see distribution higher. If we are manipulating higher, we want to see distribution lower. This is going to be with respect to accumulation we have done. And we would use the opening price of respective kill zone to spot the correct manipulation phase with respect to accumulation. So if we are dealing with New York kill zone, we need opening price of New York kill zone. If we are dealing with whole daily range, we need opening price of whole day. If we are dealing with Asian, we need Asian opening, and same goes for London kill zone. For the daily candle, we would use 12 a.m. New York time. For New York kill zone, we would use 7 a.m. for Forex and 8:30 for Indices. If our higher time frame order flow does not align with the ICT MD PO3 pattern, we will either scalp with much lower risk or we will wait for another day. Now let's look at an example of all the steps we have done through. This is your USD daily chart, and you can see we are in bullish order flow. Price is respecting the set of bearish candles and going high through it, and we are targeting the highs. So our order flow is bullish overall, and we are targeting the highs. I want you to focus right here. This part, you can see price is respecting this bullish roadblock, which is this bearish candle, and it is going high with this. Now we would go on lower time frame and try to find the daily bias with applying all the rules we have studied. But first, you need to mark the high and low of this previous candle and try to see if we are targeting the high or low. If we are in bullish order flow, we know we need a higher time frame support and we target highs. And then we need to apply AMD pattern. Now let's go on lower time frame and see what's there. This is USD 15-minute chart, and you can see there's accumulation right here. We are rejecting the low and targeting the highs. So we are dealing with New York kill zone right here. So we need to mark the accumulation to this and opening up New York kill zone. Right here, you can see after the opening of New York kill zone at 7 a.m. for the Forex, we go lower and take this sell side liquidity, and we also hit this roadblock. After we hit this roadblock and then we go higher and breaking this high right here, we are bullish. All the conditions of bullish daily bias are met, which were bullish order flow, rejecting lows, targeting highs, and a manipulation lower. All of these conditions are met. So now we need to conclude that our bias is bullish and get the entry from the first bearish candle. This can be right here on lower time frame or here or even here. Our next example is of USD JPY. This is weekly chart. You can see we have took a buy sell liquidity on the monthly chart and did a high resistance liquidity run. Then we go lower, create this weekly fair value gap and reject out of it. Now we would go on lower time frame. Right here you can see prices respecting bullish candles, which means our order flow is bearish and we are respecting bearish PD raise. This is higher time frame resistance level, so we would go deep into this candle and try to understand daily bias with the steps I told you. So let's just revise the steps. Our very first step is bearish order flow with higher time frame resistance, which is right here. You can see we are targeting the lows and rejecting the highs. So this is bearish order flow and we have a higher time frame resistance level as well. This is our first step, and then we are targeting the lows right here. Consistently we are targeting the lows. So we need to mark the high and low of candle, and our high is going to be rejected and low will be the target. And then we need to apply the AMD pattern, which we would do on lower time frame. So here's the USD JPY 15-minute chart. You can see this is happening inside the Asian kill zone. This is accumulation phase, then we have manipulation higher and the distribution lower. Now this manipulation phase, which is higher, clears our bias of bearish market. We need to see it take a high of previous day and target the previous day's low. Now after this rejection, our bias has been cleared and we would take entry from the first order block or fair value gap we see. This happens inside the Asian kill zone, and opening of Asian kill zone is very crucial as it gives us the open high low close formation and PO3 application. So that's how we find the daily bias. For the bullish market, we need bearish manipulation with a bullish strong liquidity and a bullish order flow. For bearish market, we need bullish manipulation, bearish strong liquidity, and bearish order flow. That's all clear your strong liquidity. You always need to apply these 3 steps and do nothing but to wait for the confirmation of the bias after the manipulation. That was all about daily bias. Stay sharp, stay safe.